Welcome to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri, and thank you for tuning in. I'd like to start off this conversation by wishing everyone a happy Thanksgiving, and hopefully you had some time to get some great food, spend time with family, and get a little bit of football in. So as we go into today's conversation this week, as usual, we'll discuss our 4 key focus points, highlighting key learnings from the market activities in the past week. In point number 1, we'll do a market recap with our key market indicators. In point number 2, we'll look at the personal consumption expenditures, or the PCE inflation data. And in point number 3, we'll look at tariffs and the market. And in point number 4, we'll spend some time on diversification. Now, on to point number 1, the market recap. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta Fed GDP Now report shows a healthy 2.7% growth as of November 27th, which is slightly up from the previous estimate of 2.6%. This data incorporates the BEA's personal income report. Next, each week we look at the initial claims for unemployment insurance for a gauge into the front end of our labor market. This week, initial claims data showed no change, ending at 213,000, as continuing claims slightly fell to 1.907 million. Next, for 2024, we are watching mortgage rates closely to see how home affordability is trending. This week, we saw a minor change in the 30 and 15-year mortgage rates, ending at 6.81% and 6.10%, respectively. Next, we normally look at the bull-to-bear spread, focusing on one component of investor sentiment. There was no update on the bull-to-bear spread this week. We'll track this starting up again next week. Next, we will continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating a 66% probability of a 0.5% decrease and a 34% probability of a 0.25% decrease in December. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended positive 0.77%. The Russell 2000, which tracks small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, was negative 0.28%. And the MSCI EFA, which tracks international stocks of developed countries across the globe, excluding the US, was positive 0.98%. A different winner this week, international stocks got the much needed win after the past few weeks. Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you'd like an unbiased review of your portfolio, do not hesitate to connect with one of our advisors today. On to point number 2, personal consumption expenditures. The October PCE report released by the Bureau of Economic Analysis indicates that inflation is persisting above the Federal Reserve's targeted rate. The headline PCE price index, which includes all items, rose by 0.2% in October compared to the previous month, reaching a 2.3% increase year over year. And you can see that on your screen. It's colored in navy. The core PCE index, which excludes volatile food and energy prices, also increased by 0.3% month over month, and that's represented as a light blue line on your screen, resulting in a 2.8% year-over-year rise. And once again, that's represented in orange on your screen. Economists had anticipated both headline and PCE to match September's inflation rates. Despite efforts to curb inflation, the PCE report shows that price growth remains uneven and persistent. The PCE index, a key indicator for the Federal Reserve, has hovered around 2.7% annually over the past 6 months. This stubborn inflation, coupled with a robust economy, could potentially lead the Fed to consider its policy outlook and opt for a less aggressive interest rate cut cycle. Housing costs have been a significant contributor to inflation, as reflected in the CPI, and we discussed that previously. While the CPI and the PCE index use different weighting methods, the CPI higher exposure to housing costs partially explains why it has generally outpaced the PCE index in terms of inflation this year. The FOMC meeting, which is the Fed's policymaking body will convene on December 17th and 18th to discuss interest rates. The committee will have access to November's employment and CPI inflation data before making a decision. And as we've discussed, while the interest rate futures market suggests an almost even chance of either a quarter point reduction or half point reduction, the persistence of inflation might influence the FOMC's decision during that next meeting. On to point number 3, tariffs and the market. I've been asked numerous times over the past few weeks what I believe would happen if President-elect Trump implemented the tariffs he's talked about on the campaign trail and the latest proposal focusing on Canada, Mexico, and China. A majority of reports that I've read from much more experienced economists have all pointed to an increased inflation on imported goods. As you can imagine, if the cost to import increases, the cost of the product increases for us to buy. This situation presents a complex challenge for the Federal Reserve, as we've all been watching inflation and interest rates come down. The implementation of these tariffs could derail the progress that we've made so far. It's also important to clear up a misconception about these tariffs. Tariffs, which are essentially taxes on imports, are typically charged as a percentage of the price paid to foreign sellers. While President-elect Trump asserts that foreign countries bear the burden of these tariffs, it's important to clarify that American companies, as importers, actually pay these tariffs, often passing that increased cost on to consumers through higher prices. Consequently, economists generally view tariffs as a potentially counterproductive measure, as they can increase costs for businesses and consumers reliant on imports. Higher tariffs, as mentioned, would likely result in increased prices for imported goods, impacting a significant volume of goods traded within North America. This could lead to higher inflation, and persistently high inflation could potentially lead to the Federal Reserve considering increasing interest rates in the future. So what does this all mean for investing? In uncertain situations, a North Star that can guide investors is valuation. In the long run, there's nothing more correlated with returns than whether the market is cheap or expensive compared to measures such as corporate earnings. While valuations are not market timing tools, stocks can run well above fundamentals in the short run. They do tell us how to set expectations that reflect long-term trends. On to point number 4, diversification. We talked about high valuations in the previous point, which is a component of having good market fundamentals. As Michael Scott from The Office would say, you'd be mental not to have fun. Remember, high valuations don't mean we should avoid the stock market. Instead, they suggest we should carefully construct and adjust portfolios in a risk-aware manner, using diversification as a key tool. We talk about diversification weekly, and a few weeks ago, Stephen Armstrong conducted a deep dive with us. I'd highly recommend you all to go listen to that if you haven't had a chance to. Now, what I'm sharing on your screen is a chart that shows while U.S. stocks have performed well this year, many other asset classes have generated positive returns too. International stocks, for instance, continue to have much more attractive valuations than U.S. stocks. And while bonds have not performed as well recently, they still provide income and diversification benefits, especially in periods of market volatility. Perhaps most importantly, long-term fundamentals suggest that trends are still moving in the right direction. Corporate earnings have shown steady growth in recent quarters, and GDP figures have been surprisingly strong. The Federal Reserve also implemented its second rate cut of the cycle after the election, lowering the Fed funds rate by 25 basis points to a target range of 4.5% to 4.75%. Now, during that post-meeting press conference, Fed Chair Jerome Powell presented a balanced view of the economic landscape, emphasizing both progress and continued vigilance. Your portfolio should be viewed in the same manner, balancing progress and vigilance. The bottom line, slower moving economic trends are what drive financial success for long-term investors, not the short-term market movements over a few days or weeks. As 2016 to 2020 demonstrates, it's important for investors to maintain portfolios that can take advantage of market rallies, also while protecting against periods of uncertainty. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Thank you once again for watching. We look forward to seeing you next week.